In this video, we will look at the discounted cash flows model for business valuation. This is a foundational guide that helps us value assets based on the earnings they are expected to generate in the future. To understand how this works, let us start with a simple analogy using bonds. Imagine you buy a bond that pays 9% interest every year for 10 years. At the end of those 10 years, the bond matures and you get back the face value of 1 lakh rupees. If the current interest rate in the market is also 9%, the value of that bond today is exactly equal to its face value. The rule here is simple. Value equals the present value of all future cash flows discounted at the prevailing rates. Now, let us shift our focus from bonds to businesses. With bonds, we have certainty. We know exactly when the coupons will be paid and when the principal redemption will happen. However, with equity or stocks, we face uncertainty. The cash flow source is earnings or dividends which are not guaranteed, and the terminal value comes from selling the share at an unknown price. The key insight here is that valuation errors often stem from our inability to measure the quantum and timing of these future cash flows with certainty. Conceptually, the discounted cash flow approach relies on three main pillars. To use this method effectively, we must be able to estimate three things. First, the stream of cash flows, which includes both inflows and outflows. Second, the timing of when these cash flows will occur. And third, the discount rate, which is the expected rate of return required by the investor. The methodology for this valuation follows a clear three-step process. First, we estimate the free cash flows. Second, we determine the discount rate that is appropriate for the risk level. And third, we calculate the present value by discounting those future cash flows back to today. It is important to remember that value estimates will vary across different analysts because everyone will have a slightly different opinion on the expected cash flows and the discount rates. One specific method we use is the dividend discount model or DDM. The concept here is that we value the company by discounting its expected future dividends based on the cost of equity. This model is best suited for matured companies in defensive industries that pay regular, substantial dividends. However, it has limitations because equities theoretically have a perpetual life and companies are not legally obligated to pay dividends, requiring us to make many assumptions. When a company is expected to grow forever, we use the Gordon growth model. In this formula, the fair value of a share represented as P equals the dividend expected at the end of the year, called D1, divided by the cost of equity, K, minus the constant growth rate, G. A critical assumption you must make here is that the growth rate, G, must be lower than the cost of equity, K. But what happens if a company does not pay dividends? This brings us to the free cash flow to equity model or FCFE. Many companies like Alphabet Inc. choose to reinvest their earnings for growth rather than paying dividends. The solution is to value the equity by discounting the cash that is theoretically available to shareholders after all expenses, interest, and principal payments are met. To calculate the free cash flow to equity, we follow a specific order. We start with the operating cash flow. From this, we subtract capital expenditure. Then, we subtract interest payments. Finally, we add or subtract net borrowings depending on whether the company borrowed more money or paid off debt. The result equals the free cash flow to equity. Valuing high growth companies with this model can be tricky because high growth rates are often unsustainable in the long run. To solve this, we use a two-stage valuation. Phase 1 is the high growth phase, where we calculate the present value of cash flows during the boom. Phase 2 is the perpetual phase where growth stabilizes and we calculate the terminal value. We then combine these to get the total value. Sometimes the FCFE model can be biased because it relies on net borrowings, which can be arbitrary if a company does not have a stated debt policy. To eliminate this bias, we use the free cash flow to firm model or FCFF. This solution calculates the free cash flow before considering any sources of capital, whether debt or equity. Here, we use the weighted average cost of capital or WACC as our discount rate. There are two ways to calculate FCFF. In the direct method, we take operating cash flow minus capital expenditure minus the tax benefit on interest payments. In the indirect method, we start with EBIT multiplied by 1 minus the tax rate. We then add depreciation and non-cash charges, subtract any increase in working capital and subtract capital expenditure. Note that gains on asset sales are deducted here while losses are added back. Once we have derived the firm value by discounting the FCFF, we need to bridge the gap to find the equity value. We start with the firm value and subtract minority interest, preferred share capital and interest bearing debt. Then we add any surplus cash and short-term investments. The final result equals the value of equity. Forecasting these numbers requires careful judgment. We refine historical trends with analyst insights, considering factors like how much earnings are plowed back into the business. For the terminal value, which represents the future beyond our forecast, we can use the perpetual growth method, capping growth at the long-term GDP rate. Alternatively, we can use an exit multiple method where the terminal value equals EBITDA multiplied by a comparable multiple. Now, let us look at the discount rate. This rate must reflect both risk and investor expectations. For firm valuation using FCFF, we use the WACC, which considers both debt and equity. For equity valuation using FCFE, we use the cost of equity, which considers only shareholder requirements. The cost of debt is usually just the prevailing interest rate for companies with similar credit quality. To calculate the cost of equity, denoted as KE, we use the capital asset pricing model or CAPM. The formula is KE equals the risk-free rate RF plus beta multiplied by the market risk premium, which is RM minus RF. Here, beta represents the systematic risk or the stock's sensitivity to the market, while the risk premium is the extra return required for taking on that risk. To find the weighted average cost of capital or WACC, we use a weighted formula. WACC equals the cost of equity times the weight of equity plus the cost of debt times 1 minus the tax rate multiplied by the weight of debt. The term 1 minus tax accounts for the tax shield benefit of debt. This is the rate used to discount FCFF to arrive at the enterprise value. In conclusion, DCF models are powerful tools for valuing businesses based on their future potential. However, you must be careful because the output is highly sensitive to the inputs. Be warned that valuations will result in erroneous output if sufficient rigor does not go into estimating the two primary drivers, which are the cash flows and the discount rate.